Good morning, everyone, and welcome to Weekly Profit Talk, where every week we sit and we talk about the things that affect the bottom line of your medical practice. Um, we do this every single Wednesday at 8:30 a.m. Mountain Time, and that is 7:30 if you're in LA, 10:30 if you're in New York. Let's launch right into this week's topic, which is avoid these 5 costly financial mistakes in your medical practice. So, um, without any ado, there are certain things that you can avoid simply, and we've basically put together a little presentation for you. So let's go ahead and we'll start this here. Number one, overhead cost mismanagement. Now, the definition of an indirect cost is basically something that you've got to spend that doesn't directly affect patient care. Um, so there's things like administration, registration, housekeeping, those sort of things. Another one is software applications. And this is an example. It might not be your most expensive one, but I find that this is valuable not only for medical practices, but for anybody. You can subscribe to software as a service, or SaaS, as I've grown to call it, and forget that you have it and stop using it. And 3, 4, 5 months down the road, you're still paying for something on auto debit from a credit card. It pays to audit your overhead expenses. This is just one small and probably not very expensive example, but it outlines the importance of taking a look at these things. There are certain costs that you can um, address without uh, making everybody believe that you're Ebenezer Scrooge. There's a difference between uh, being horribly tight and being ruthlessly efficient, but you can do it and still be a compassionate leader. So another one is negotiate aggressively with your suppliers. They expect it and they build it into their pricing. If you're dealing in volume for specific items, don't just accept whatever they have to charge. If there's a possibility that they might, in fact, work with you based on the quantity that you're purchasing. Also, terms will help you. Like if they do net 15, net 30, that sort of thing. Delaying payment legitimately on expenses is actually a good fiscal practice because the longer you hang on to your money, the more interest and other earning potential it creates for you. Um, Payment terms as well as the actual cost of items is something that you can address with your vendors, and you can actually find cost effectiveness there. And also your human capital. If you Now, think of it this way. Let's say you have 7 people on your staff. Sooner or later, somebody's going to want some time off. You need to provide vacations. Okay. However, you do that, people need to decompress. They need to spend time with their families, and somebody else should be cross trained on that person's duties. So it just goes to follow the next step in the logical progression. Consider cross training and make sure that you have more than one person that knows how to do one specific thing in your practice, um, not only for vacation reasons, but just for office efficiency reasons in general. So, number 2, poor billing and collections management. Claims receivables are going to be the bear of medical practices. You're dealing with government indemnifiers such as Medicare and Medicaid, as well as private insurances. And of course, there is the uh, collection of payments from patients themselves. Hopefully, you've instituted a system where you're basically collecting patient copays and coinsurance at the time of the beginning of service to the greatest extent possible. Now, you might not be able to get coinsurance right up front because there's a mystery amount coming from the insurance company, but copays certainly should be collected upon the first encounter with the patient. And that's probably something you've already thought of, but it's important. Um, I'm sorry, to proceed on that thought though, once you have hopefully properly completed a claims form or done an electronic health record submission, or a claim submission, it's out there in the ether somewhere. And each day that it sits unpaid, it's basically aging. And aging receivables are the little death of a practice. You definitely want to be looking at your 30 and 60 day aging receivables, and 90 for that matter. That should be something that you are paying frequent attention to. If you're not looking at that once or twice a week, there's a possibility that you're actually having difficulty with cash flow in your practice. So train and retrain on accurate coding. If you get one number wrong in a CPT code, I'm certain you're aware, you've probably had a claim sent back because something was sent wrong. So continue to always ensure that your coding is accurate. Remember, they update this annually, and make sure that your CPT as well as your ICD-10 is up to date as well. You need to review your denied claims as a priority. And again, we've talked about aging receivables as well. So critically important. Ignoring retirement planning. Number 3, you are at some point in the later part of your life going to probably be thinking about not working as hard anymore. One of the things is, after 20 years of practice, maybe you've got a book about your experiences boiling in the back of your head and you want to have more time to write. There's a possibility, right? So if you think about things such as this, or perhaps you're interested in volunteer work or just spending more time with your family, what your hedge against future prosperity is saving now. If you can afford to save up to 50% of the money that you bring in net income, then by all means do that. There are, of course, and we've talked about this in recent previous weeklies, you can save in tax deferred methods that go beyond the mere investment in IRA. That gives you a $7,000 limit, and that's $14,000 if you're married, 7 for each of you, of course. But you can go well beyond that. If you own your own practice, you are actually able to contribute as the employer as well as the employee to your future retirement. And depending on the affluence of your business, you could be saving over $60,000 or $70,000 a year in tax-deferred I-401k investments. Of course, I love the S&P index. You know that we're living in volatile financial times recently. If you watch the news, and I try to watch as little of that as possible, but you have to be aware of some of the things that are happening. Of course, filtering things for the bias is important, but the main thing is that things have been a little different since January in the financial world. But the 500 to 510 companies that make up the Standard & Poor 500 are basically stuff that people are going to buy. That's why they're on the index. And sooner or later, the market has what they call corrections, which is these dips. We had a huge correction in 2008 when the ninja loans came to call. And of course, 2020 and the pandemic. And we had pretty interesting dip in February. But if you're looking the last 3 days, S&P is actually starting to show some gains some days. That's because people are going to keep buying things. We live in a consumptive society. And again, that's one of my favorites. If you have the kind of heart to actually self-administer that with a little bit of help from the customer service of the financial house, you'd be amazed how low your expense ratios are on these kinds of investments. You can do this. I think I'm doing 0.2%. If you go to a mutual fund, you can be paying anywhere from 2.5% to 3.5% in fees. So there are much cheaper ways to do the savings as well. And though I am not a financial advisor, And the financial advisors don't like to play in my tax sandbox either. But I can help with that sort of thing with the business advisory services that we provide. So, and you should always, I was talking about your future and maybe slowly exiting your business or outright selling it. You want to always build your practice with an eye on that. In other words, would it be attractive to a buyer? So, um, it's a good thing to keep in mind. Uh, Mistake number 4, the trap of debt leverage. This is awful. Now, most of my medical practices don't have too much difficulty with the concept of paying the statement balance on credit cards. This is a huge issue, though, for a lot of small entrepreneurs in this country. And I'm certain there are some medical practices that are guilty of it as well. If you are running credit card debt and paying as much as you can, a little bit over the minimum, you're basically financing a loan at somewhere between 18 to 30 or more percent. It is absolutely killing you. Credit cards are a valuable tool when used properly. And by properly, I mean use them to legitimately delay payment on your expenses for a month. Um, of course, the expenses will run through your books at the time of transaction. And then you're basically making a transfer from operating checking to your credit card when the bill comes due. If you pay the statement balance, you don't pay interest. It's that simple. So you want to set up your business so that you are able to do that. If you keep sufficient operating checking balance, you should be able to, or savings balance for that matter, you should be able to set up an auto debit from one of these accounts and let that make your credit card payment automatically and do it on time. Do it to the full statement balance. Okay. But there are other major debt leverage decisions that you have to make. Maybe it's time to get that MRI or you need an x-ray machine. And I know even chiropractors will benefit from being able to x-ray extremities and those sort of things. Um, this is a major decision that needs to be undertaken with seriousness because you are going to be basically indebted to this, and it's going to have a cost beyond the cost of acquisition of the asset, and that is, of course, the interest that you will pay. I cannot stress this enough. If you've got the wherewithal, make sure that you're back ending that payment. Let's say that you got $1,000 a month that you've got to pay toward an x-ray machine, and your amortization is such that half of it is interest at this point. If you pay $1,200 instead, that's additional $200 will go toward the principal. It actually moves your payment schedule down in the amortization schedule, and you get it paid off much more quickly. So I can't stress this enough. Manage debt intelligently. I know a lot of you have $250,000 to $500,000 in student loans, and this is a big deal as well. So the object of the game is to get as debt free as soon as possible, and sub object of the game is to audit your debt and take the statistical information for how much you are paying in interest on each one. Pay off the highest ones first. Those are going to be credit cards. And then you'll take a look at the rest of your long-term payments that you're making. If you're paying 7% on one thing and 4.5% on another, you may want to consider paying off the 7% one next. Okay. So enough about that. Lastly, and this is up my alley, refusing to plan for the inevitability of taxation. Now, I still see medical practices that, despite the fact that they know that they're going to owe over $1,000 in taxes at the end of the year, and that's very simple to do. You can make as little as $40,000 in net income and over $1,000. So it's going to happen. If you are any kind of physician at all, particularly if your practice is scaling and growing year to year, you need to make estimated tax payments. This is a requirement. I'm telling you that this is maybe the most important thing that you do. There are two reasons why this is important, and I harp on this frequently, but I'm going to go ahead and repeat it again. The first one is what I call the clean room in your mind analogy. Simply this: if you know that you're going to have a large debt in March or in April of the following year, 2026, and you allow that to accumulate, that's going to sit back in your subconscious and basically accumulate uh, and create more stress and the dust of misuse and lack of attention. But the second and most important thing is that taxes are an expense, and though they are a personal expense of your household because you are paying income tax, and that's basically something that you do with the spouse, or if you are single, of course, but you pay your taxes on a Form 1040. The source of the income is another story. You may be filing a partnership or S corporation return, and that will have all your business income. But the taxes that you pay themselves are a personal expense, but you have to budget for them. And simply, the best way to do this is to estimate the tax that you're going to have for the period of year that has elapsed um, by taking your business performance up to that point. Let's say April 15th is coming. That's the first estimated tax payment deadline. A perfect timing. It's the same as the 1040 deadline, but nevertheless, you have to plan for it. If you're going to owe $15,000, $20,000 in taxes this year or more, and that's very likely as a practicing physician, you're going to want to pay somewhere near a quarter of that in on April 15th. There are underpayment penalties for not doing it, but the other thing is when you make these payments, you're also matching the expense to the period of time in which you created the revenue that created the expense in the first place. Hopefully that makes sense to you. So estimated tax payment planning is probably the most critical part of your success and your wealth building strategy. But there are certainly other things that you can do. Going back to that asset acquisition, for example, and you saw that on the previous slide, that debt is just another form of capital expenditure. You'll see on a balance sheet, actually, that liabilities plus equity equal your assets. So you can basically leverage asset acquisition through debt, but you are most likely going to be a lot better off if you can do these as capital expenditures. And the way to do that is to build up the wealth of your practice, obviously. So with that, main thing is that there are other ways to plan for taxation, both all year round and at the end of the year as well. Purchasing assets and depreciating them on certain schedules is an example of what I'm talking about. There was bonus depreciation. That may or may not be going away with the end of the year. The Tax Cuts and Jobs Act reforms expire on the 31st of December. But similar people were in power that put the TCJA into effect. And so something's probably coming this year. I'm uncertain what, but I'm certainly paying attention for you. So with that, proper tax planning and paying your taxes year round, you should actually look forward to your Form 1040 filing, because it should be a reconciliation and a measure of the metrics of how you did during the year. Your taxes are already paid because you've been making your estimated payments all 4 times. Very important. So with that, I hope you found this very useful. I certainly enjoyed sharing it with you. And if you'd like to learn more about how tax planning, forecasting, and other wealth building strategies with business advisory services can elevate and accelerate the growth and scaling your practice, then let's talk. I'm coming to you on One of Three Media. They are, of course, LinkedIn and YouTube, as well as Facebook. All 3 of those have a comments section, so you can just say anything in the comments at all. I'd like to learn more, or just learn more. 2 words. Or you can write to Eric at owingsllc.com. Be very happy to sit down. A first discovery call, as I refer to it, never has any cost. And we'll sit and we'll talk about how we can help you realize your wealth and growth strategies. So if that sounds good, reach out and let's talk. Until next week, we do this every single Wednesday at 8:30 Mountain Time, be that standard or daylight. And we look forward to seeing you next week. Have a great day. And if you have a chance, do something randomly kind for a stranger. So until next week, so